Good afternoon, everyone, and happy holidays. Thank you for taking a little bit of time to spend with myself, David Scherer, and Spencer Levy, the head of global. Spencer, do you want to say strategy, communications? I'm going to give you a full introduction in a moment, but amazingly accomplished. Origin Investments, if you don't know us, we manage about $5 billion, all in multifamily and across three strategies: credit, buy and hold, operating assets, as well as development. Lots of questions were emailed in. I think we have 850 guests. And if you're an investor, great. If you just want to learn more about the real estate industry, great. Everybody is welcome here. I'm going to introduce Spencer. We have only an hour, so I want to make sure that we're respectful of his time. And then we're going to just jump right in. Spencer Levy is the global client strategist and senior economic advisor at CBRE, working with the firm's largest investor and occupier clients. He's also chairman of Real Estate Roundtable's Research Committee and host CBRE's award-winning podcast. We were talking about this earlier, Spencer, The Weekly Take. If you haven't listened in on that, please do. It's the most downloaded podcast on commercial real estate globally, which I was blown away. That's very impressive. So I'm not going to weigh in much. I really want to hear about Spencer's views. I have prepared with our team a list of questions, and then we're also going to open this up. I would say about 100 questions were emailed in prior. We've downloaded many of those. And then if you have, just click on the Q&A box, and we're going to spend roughly half the time just handling questions from you, the audience. But first, we're going to start with a couple questions that were sent in from our team, I would say, at Origin. And so I've kind of grouped these into macro, Spencer, but the first is kind of the stage in multifamily: interest rates, rent recovery, GDP into 26, inflation. But I'm going to ask you a couple questions, and I'm sure you take it wherever you want to go with it. The first question is, after a year of uncertainty, certainly the tariffs and Liberation Day in April, but just the multifamily sector in general, what do you think the multifamily sector looks like today, and what are you looking at into next year?
First of all, delighted to be here, and thanks for all of the terrific listeners here. And throw in your questions as soon as you can, we'll get to them. So here's the big picture and how it applies to multifamily. The big picture is that multifamily went through its golden era probably from 2012 to 2022. And when I say it's golden era, I mean an era where interest rates kept declining, occupancy kept increasing, rents kept going up. And then we hit hyperinflation. We hit hyperinflation from 22 to 24. It's certainly slowed down since, but we're still in a high interest rate, high inflation environment today. And that has changed the space. It changed the space in multifamily because it became more expensive to build. And that means in 2024, we had a record amount of new deliveries. New deliveries coming on now, online now, are diminishing rapidly because of increased interest rates, because of increased cost of construction. And we've also seen, because of that max new building in that 24 period and before, some softness in some of the areas that were the hottest areas in multifamily. And the hottest areas are places you know well: Southeast, Southwest Texas, Austin, Texas, overbuilding, and rents have been soft, if not declining in some of those markets, and vacancies have gone up. So that's the bad news. Here's the good news. If you're in this for the long term, multifamily is the best place to be. And I say that as a guy who's a big fan of retail, big fan of office too, notwithstanding its challenges. And why is that? Because we have massive shortages of housing of all types. And so when you take a look at multifamily, you got to break it down from the market rate housing to the capital A affordable, and then other subcategories. And other subcategories are things like manufactured, things like senior, things like student. There's a time and a place for all of this over the intermediate to long term. That said, in the short term, in the now, you're going to see some pockets of weakness where there was overbuilding, where rents are softening, and where vacancy has increased. But I'm still very bullish over the intermediate and long term multifamily.
Spencer, I get this question all the time, and I want to hear your answer. We have our own proprietary AI that takes in billions of pieces of data. It's called Multilytics, and unbiased spits out rent projections a year, 2, 3, 4 years out. And that AI was projecting stabilizing rents in Q1 and Q2 of this year, and rents that were going up in Q3 and Q4. It's been incredibly accurate over the last 5 years. But this year, candidly, it missed the recovery. I have my own thoughts on what 26 is going to look like. But if you're a multifamily investor today, the question I hear a lot is, I keep hearing about the recovery, but it's not really happening. I mean, there's concessions in markets, there's rents that really aren't going up, and there's this disconnect between what people see today and what they expect to see in the future. And so, I'd like to hear your thoughts on 26, the supply demand going forward, and why.
Sure. Well,
And
first of
rents,
all,
and how it shows up in actual rents.
if you let me test drive your AI next week when I'm on vacation, and I may hit it to Gulfstream the track and see if it helps predict the horse racing results. I will nevertheless give you my point of view for next year on where rents are going. So when you're taking a look at multifamily rents, it's no different than taking a look at yields on real estate vehicles. And they say, well, what does one thing have to do with the other? Because you're dealing with alternatives. And in the case where you're looking to buy a share of a publicly traded REIT stock or buy into a private vehicle that gives you a dividend, your alternative is to buy a bond. And if you can buy a bond where you have a high interest-free return on things such as municipal bonds, or much higher return on things that are taxable, that might look better on a relative basis. Multifamily rent versus buy is no different, where people are saying, it's really expensive to buy right now. It's really expensive to buy right now. Before you put aside the things like putting down a deposit, you have to pay interest rates on new purchases on your best day. Your best day, you're looking at 5.5% mortgage rates. And if that's the rate on a $500,000 house, okay, I'll math this for you. That's $27,000 a year, 5.5% or so. That's a lot of money. And, your alternative is to rent. And if your rent is looking better and you don't have to put down the deposit, well, that's what you're looking at. So when you're, as a multifamily investor, you have to look at the macro and the micro. The macro is, where are interest rates going? Now, I will tell you, as a multifamily investor, on balance, I would much rather have lower interest rates than higher interest rates. That said, if interest rates get really low due to a market shock of some sort, like a big stock market correction, it will sap some of the demand away from renters, because some of that demand for renters will go to the buy side and buy stuff, because the renters are in the buy versus rent camp. Now, this is why when I advise my multifamily clients, I was like, look, market rate is a big piece of the market, and it's probably the biggest piece that the institutions own. But you then have to go down the quality spectrum. You go down that quality spectrum to workforce, which is not capital A, and the difference between workforce and capital A is just cheaper housing that is not government regulated. Then you go to government regulated, which is capital A. Then you go to the sub asset classes and you say, gee, where am I going to get the durable demand drivers? You see that? 3Ds, durable demand drivers. And as you go further down the quality spectrum, you get much more durability, because people that go to the higher ends of the multifamily market are very often renters by choice. People who are renting at the capital A and certain workforce are renters by necessity, so they're stickier. And once you get into the capital A category, that's where you also get inflation adjustment to your rent. So you get the added bonus of sticky tenants, inflation adjusted rent, as opposed to market, where you have renters by not necessity, by want, where you don't have as much durability and you may not have as much pricing power. So what do I see in 26? Assuming interest rates stay around where they are, it's still going to be a very good market for existing product and you're going to absorb a lot of that softness that we see in the Southeast, Southwest, and Texas. But I still think people should diversify and own at some of these lower asset classes as well, because that's where you're going to see more durability.
Yeah, Spencer, my answer is multilytics RAI is correct, but the slope was incorrect. It predicted a much more violent correction due to oversupply in the short term. And that
Well, I guess I would guess if
sorry.
I program, and I don't know if it's going to work for my horse racing either, but I think the key variable is interest rates. And the interest rate variable is the one that if they didn't take it into consideration enough, it may have been the reason why it missed.
My opinion is it missed because the supply that was being delivered, it's able to quantify supply based on permits, starts, et cetera. It was delayed because the system was overwhelmed in 21, 22. There were too many starts happening. And so the cities got bottled up, and then there was construction overages, delays, restructures. The supply's taken much longer to hit than we projected initially. Like normally, if you think about what happened here in 21, 22, there was too many multifamily units started. And generally, they should take about 2.5, 3 years to deliver. They should have been delivering throughout 23, 24, 25. We should be past it. But they were delayed. And so the slope wasn't as steep, but it's just a long-winded way of saying I think 26 is going to be much, much better as supply finally hits, is absorbed. And the key there is absorption, and maybe you can speak to this. Absorption of multifamily is really at an all-time high, and that's not talked about enough. And you mentioned a little bit about the cost to own versus cost to rent. Maybe you could unpack that cost to own, cost to rent, and how it's affecting our demand curve, which is essentially absorption.
Sure. Well, I think the cost to own versus rent, cost to own is really two factors. It is the deposit that you got to put down, and then it's the cost of the carry versus the cost of renting something where you don't have the deposit and you don't have many of the maintenance costs. What you're dealing with today is a third factor, which a lot of people aren't talking about right now. And I'm not judging this morally. I'm just laying out a fact for you. Student loan forgiveness is over. And now that student loan forgiveness is over, you're going to see more people that might have been a buyer be renters for longer. Again, I'm not judging this morally. I'm just giving it to you straight that one of your most likely first-time buyers is now a significant percentage out of the market because they simply don't have the money to put down that deposit. So there are all these factors that are at play as to who is going to rent more versus less. But rather than just saying you're going to see more renters next year because there's less supply, I still think you need to break it down by the quality category, because I believe firmly that the lower quality product is going to have a stickier tenant base than will the higher quality product when you're dealing with renters by choice.
I'm going to make it about next year again. So at Origin, we haven't launched a growth fund since 21, 22. And it's because we didn't see that these factors were lining up. Instead we expanded very deeply into credit, initially preferred equity, and then senior loans, all on multi. And that's,
by the way, I like that strategy. And I'll tell you why I like that strategy. Because what I said about the golden era, and the golden era, let's just say it ended in 2022, was that there were a lot of people who bought in that golden era, particularly 18 through 21, at sub-4 cap rates. And guess what happened? They bought it using floating rate debt. The debt came due. They had to refi at existing market rate. And so what do they need? Preferred equity or stretched firsts, which is what you provided. So you provided what was needed in the market at the time. But the fact that you're shifting today is because we may not need it as much today. We still need it. Believe me, people who bought in the 19 to 21 period will have capital markets issues for some time, but we don't need it as much.
Yeah, and I think you would agree. It was exacerbated when Silicon Valley Bank failed and all the regionals got afraid, and they essentially banking just stopped to real estate Q2 22 and on. It's recovering now, but it's been 2.5 years, and that's an amazing opportunity set for us because we get to step into that void where the banks usually are playing, and it's mainly debt funds that did that. But the reason we're shifting into equity, Spencer, is we believe now, and when I say equity, I mean development. Origin is one of the largest developers. We're in the Southeast, Texas, and the Southwest, and we currently have 14,000 units in development. We're very big, and we do a lot of it. Some for qualified opportunity zones, some for market rate. In some instances, you mentioned this earlier, we do affordable housing in Texas, programs like HFCs and PFCs. But our development, the reason that we're going back into it and starting it again is construction costs have actually gone negative. I get this question a lot. With the tariffs, is there inflation in construction? There isn't. And it's because there's so few starts, and the GCs and subs are now really needing work. And so they're able to accept a much lower margin, and that's what's happening. Interest rates are lower, way lower. So with construction, you're borrowing variable. We were borrowing at 250, 285 over 5.25 SOFR. That's 8%. Now we're borrowing at 250 over a 3.5 SOFR, 6%. Makes a big difference. But most importantly is the supply-demand imbalance. There haven't been enough starts in 22, 23, 24, 25. It's been a precipitous decline in starts. And so when we look out into the future, we think there's a big supply-demand imbalance in 27, 28, 29. And we want to be part of that delivering supply. That's my thesis. And we're executing on it. That's why we're raising and deploying into our markets new development for the first time in 4 years. What is your opinion on 26 as a vintage year? When I say that for multifamily development, when I say that, I mean you are coming out of the ground in 26 and you're delivering in 28, 29. What is your opinion on that as a vintage year? Because you and I both know in development, vintage matters.
Yes, and it's always the case where the best time to build is when nobody else is. And I wouldn't go so far as say nobody else is next year, but I will say in the last 18 months, it's been extremely difficult to get joint venture capital, institutional joint venture capital into the multi-sector because they couldn't get to whatever their magic yield to cost was. And the magic yield to cost used to be about 6%, and people just couldn't come close to that. And you just did the math for everybody else. If your cost of debt is 8%, how are you going to get there? Particularly if your labor costs are high, and the labor costs were high, and they still are in certain markets because you have a transference of that labor from commercial or residential real estate into things like manufacturing. So same person swinging a hammer on a manufacturing site is the same person swinging a hammer on your multi-site. But now that you're seeing less and less of the construction, that supply-demand imbalance is helping you. So yes, as far as a vintage year to build next year, amen. Okay, I am 100% with you on this because by 3 years from now, when you come out, inflation should be in check, or certainly more in check than it is today. Interest rates will be at least 100 basis points lower, and you will see you'll be the only new game in town. And this is really important, particularly when you're dealing with the market rate segment. Remember how I segmented the market a minute ago to market rate, capital A affordable, workforce, manufactured? When people are renters by choice, if you're building the best stuff in market, you're going to get all the demand when you're the only new game in town, and people will lift up and move from there, what used to be the best game in town, into yours. So I agree with it from both a mathematical perspective, if you are truly getting the kind of yield to cost that justifies it on the going in. But I also believe it on demand for units perspective, because when you have very little new supply, the market rate segment does very well.
Yeah, and the one thing we're not touching on is multifamily has been really de-risked in the sense that in 21 and 22, the multiple on our earnings was 28 to 30. I mean, we were trading a 3.4, 3.5 cap in growth markets. Now it's trading a 5 to 5.25. We're an 18 multiple, and so whenever we develop, we're developing to a 30, 35% margin, but it's a margin based on 5 to 5.25. So in other words, we're developing to 6.5 now. We did the same thing in 21, 22, but that 35% margin was based on, we never started below a 4, but we would start at 4. And so we were kind of basing on a 5.5. You understand what I'm saying? So it's just building to a higher yield is better. That's an easy way to say
Yep.
it. So Spencer, shifting gears, I get this question a lot in different forms, and I'm sure you do too. So we're making these assumptions, and whenever I make assumptions, it's largely based on things staying the same. Meaning, I think it's difficult. It takes an exogenous shock to move something. So for example, now we just priced a deal this morning, and it was best and final going to GMP on a development in Tampa. And we got $1 million additional dollars in savings that we hadn't even modeled or expected, because there's downward pressure on construction right now. It's just there. And when you go best and final, they sharpen their pencils, and the subs get really serious because they want to win the business. That wasn't true in 21 and 22. And so it's going to take an exogenous shock. Something has to change, or there just won't be construction inflation going into Q1, Q2, Q3. Objects in motion stay in motion, is my point. With that said,
Well, look, go ahead.
we're making forward statements, and I want to know what you think can go wrong. It's an exogenous shock that happens in 26. So if we're sitting here in a year, we're saying, oh, we missed that. Like, wow, that happened. What would that be? What do you think, most likely 1, 2, or 3 would be?
Well, I'm going to slightly deviate and talk about what my fall presentation has been about. And it was a Beatles themed presentation. And the relevance of it is this, because if you listen to some of these Beatles songs, they all have a very similar theme. Like you listen to Obla Di Obla Da, Life Goes On, Within or Without You, Life Goes On Without You. And even Revolution, you listen to that song and say, well, you say you want a revolution. Well, we all want to change the world. I use that as a headline, because a lot of people are like, oh, we should worry about these macro headlines. We should worry about geopolitics. We should worry about things happening overseas. And I'm not telling you, you shouldn't worry about those things. What I am saying is that when you are in your investor hat, you've got to look at a spectrum. On one end of the spectrum is the noise of the moment. And the other end of the spectrum is the most important word there is in finance. It's called math. And the math is what you should be focused on, and what is going to impact that math the most. It's not going to be exogenous shocks from overseas. It's going to be a domestic shock that's going to do it. And a domestic shock, that's something that has the most impact on what you do. And the most impact on multifamily are interest rate related. And what's going to shock interest rates more than anything else? What's going to shock demand more than anything else? Interest rates moving up or down. So going right back to your question, and forgive me for the colorful analogy about the Beatles. I'm happy to talk about that all day. The exogenous shock that I think that would have the greatest impact on multifamily would be a significant stock market correction. And because I think that all the other noise about geopolitics, wars, et cetera, marginal impact on interest rates. Major impact on interest rates, stock market shock. So back when I was a little bit younger, there used to be this thing known as the Greenspan put. When Alan Greenspan was running the Fed back in the 80s, before Bernanke, every time the stock market had a shock, there was an implicit Greenspan put, meaning that the Fed would drop rates rapidly. I think even though the Greenspan put no longer exists, even though we have more inflationary pressures now than perhaps we had back then, I think the last thing that the Fed wants is a jobs market shock. And so a jobs market shock would occur if you saw a significant stock market pullback. And so back to your question, this one cuts both ways. You would see significant reduction in cost of construction if we had a stock market shock, because you would see higher unemployment, meaning labor costs would go down. And you would also see a shock in the form of interest rates coming down. Now, that cuts both ways. Number one, great for new developers, cheaper to build. Number two, for people who have the cash, makes it easier to buy. So there's a little bit of a yin and a yang here where, well, it's easier to build, but people will be buying more than they rent on a percentage basis than they're doing today, though they may be poorer because there's something out there that's known as the wealth effect. The wealth effect impacts people when your 401k account goes up or down by 10, 20%. You feel richer, you're going to go buy the fancy car. Goes down by 20%, you're not going to buy that fancy car. Same thing with house buying. So some of the demand improvement by the form of interest rates going down will be materially softened by the decrease in the wealth effect. So it's a long, fancy way of saying this. The stock market is the single most relevant exogenous shock that I would see. I do not see an exogenous shock in the form of the Fed becoming too dovish, meaning that dropping rates too quickly, even though that's what a lot of the administration is saying. I think the bond market would revolt if they started dropping rates too quickly in the face of high inflation.
Yeah, that's an interesting last point, because that's exactly what happened the last time they cut. When the Fed stopped raising and then started cutting, a really interesting thing happened in the yield curve, which is it was inverted and then it went to a normalized yield curve. And the 10-year note yield is much more important to real estate and cap rates and multiples and long-term borrowing costs. And that actually wound up way higher. It was 3.8, sub 4, and then it was done. It was at 4.6, even though the front end was coming down. And so you're 100% right, and we've seen it, right? If the bond market believes that the Fed is going to be ultra dovish, like, be careful what you wish for. We have $35 trillion to refinance. I mean, you don't want the bond market revolting. I'm going to ask you one more question, then we're going to go to
I'm going to give
live.
one simplifying assumption, if I could, before your last
Sure.
question, which is,
Sure.
folks, we can get as fancy talk here as you want. The 10-year treasury is the single most important number in finance because it tells you everything you need to know about finance, but it also tells you more about geopolitics than you know, because the 10-year moving up and down isn't influenced by the Fed. It's influenced by exogenous activities. But next question.
Yeah, my last question, then we'll go to live questions and emailed in, is so if you're an investor listening to this, what's actionable? What do you think, Spencer? Where should they be allocating? And just presume they want exposure in their portfolio to real estate. Where should they be allocating? Is it in development? Is it in real estate credit? Is it in buying existing product? We haven't talked about this, but I hear a lot about how, certain parts of the country it's cheaper to buy than develop. Is that true? Does it matter? I'm going to leave it at that. But there's a lot of questions. But the theme is, I'm an investor. I'm listening. You're the smartest person in the room. Where should I allocate?
The question I always ask when people ask me that question, and I get that question a lot, isn't your cost of capital, it's your time horizon. And the time horizon matters more. And so let me go back for a few of the predictions I made in the last 5 or 6 years, most of which came true, some of which didn't. All right, the ones that I was most proud of was 5 years ago, I said that open air retail is the most undervalued asset class in real estate. Well, how you like me now? All of the core money is going into, or a lot of it's going into open air retail because the pendulum swung too far. Another thing I said a few years ago was San Francisco is the most oversold market. You should be backing up the truck. What's our number one market for multifamily rent growth right now? San Francisco, which brings me back to your question. If you're in it for the short term, meaning that I have a 3 to 5 year time horizon, my answer for you is different than if you have a 5 to 10 year time horizon. So if you're looking at a 5 to 10 year time horizon, I look at both cities and asset types. And over that 5 to 10 year period, you're going to go through your ups and your downs. You look for those markets that have the greatest durable demand drivers. Markets that, there may be some political changes at the moment. And as a matter of fact, if there's political problems at the moment, even better, because then people who will be leaving the market, you might get in at a discount. So I like the big markets, the New Yorks, the San Franciscos, the Miamis, the Dallases of the world in the long term, because they're going to be durable over the long term. Now, I know some of your investors are looking to get more investment return in the short term. Number one, and I say this not just because I'm on this call, I completely agree with the thesis that next year is going to be a great year to invest in new development. But here it is. I'm going to use the O word, hate to say it, office is oversold. And we are beginning to see a flood of new capital going into the best office in the best submarkets where people are getting it for a song. So, and by the way, it's not completely divorced from multifamily, because in some of these markets, most notably in New York, you're seeing some of it converted into multifamily too. So my short answer is short-term investors, office, new development. Long-term investors, major markets. And in those major markets, you can go into a variety of asset classes, but I'm most bullish on office and retail. Multifamily and retail. Uh, and I think office is great in certain submarkets, but it is for a shorter term investor.
Terrific. We're going to move to the Q&A, and we have quite a few. I'm going to avoid questions that are regional or city level, just because we just don't have time to cover that. But if you have interest in that, email me, david@origininvestments.com, and I'll have one of our team members. We have roughly 70 people. They'll make sure that they answer your question. But we're going to stick to more broad themes. We would be remiss, Spencer, if we didn't talk about AI a little bit. And this question hones in on that. And basically, the question is, how will AI affect commercial real estate and the finance industry over the next 5 years? They pick a 5-year horizon. And how will things, look within real estate relative to that? Love to hear your thoughts.
Sure. So when you look at, much like my other answers, I always go macro and micro. Let me give you my macro answer first, and then I'm going to give you my micro answer. So I was at a meeting the other day. One of my many things that I do is I'm the chairman of the Real Estate Roundtables Research Committee, so I get to meet with the feds all the time. And one of the people I met with the other day was Kevin Hassett, who is the President Trump's head of the Council of Economic Advisors, and probably 50-50 the replacement for the new Fed chair, for the old Fed chair, Jerome Powell, when his term is up in May. And so the short answer I asked him was, CBRE's house view is that GDP growth in the next few years is going to hover around 2%. Scott Bessent, the Secretary of the Treasury, thinks we're going to hover around 3%. What do you think? And he said, starting in 2027, because of the one big beautiful bill, among other things, we're going to grow it close to 5%. Okay, folks, you can drive a truck through those two numbers. The difference between 2% growth and 5% growth is the difference between the Beatles and the worst band you've ever heard, right? It's night and day. And I said, well, how'd you get there? He said, well, you're going to have less regulation, less taxation, better business environment. And then he said AI. And I was like, that's a lot of AI, because GDP is only productivity plus population growth, and population growth hasn't exactly been gangbusters when we're below the replacement rate on birth, and we also have restrictions on immigration. But then I looked at the second quarter GDP numbers, and you know what I saw, David? 37% of second quarter GDP was due to AI. So if that was backward looking, what is it going to be forward looking? I'm a little bit more bullish than I was before. I'm still not at 5%, but I'm probably closer to that 3% with Bessent. Okay, what does it mean for real estate? Two things. So first, let me tell you a story. I was a young lawyer in New York City a long, long time ago in a land far, far away. But what was my major task as a real estate lawyer in New York City in that land long, long ago? I did a lot of lease abstracts. And you know what a lease abstract is you do a lease and then you summarize it. Not the most exciting world in the world. And so I was at a presentation the other day with the CEO of a REIT named Joey A. Gree, does triple net work. And he said he dropped his legal costs from $1.8 million to $200,000. I'm like, how'd you do it? He goes, I take that lease, I stick it into AI, and done. $1.6 million legal fees, sayonara. And a lot of people say, oh no, that's the end of the legal profession. I was sitting there and said exactly the opposite. I said, thank God. And you know why? I don't like to sit around in abstract leases. I like to sit around and think what makes my clients money. I like to think about value. And what this goes right to the micro part of the answer. Yes, it is going to disrupt some lower value add work, but it's going to free up time for higher value add work. Like, how do you drive demand into your buildings? And let's face it, folks, most commercial real estate, with the exception of multifamily, where you need a place to live, and industrial, which is a place to store your stuff, is a want, not a need. And because of that, the people who can build the better mousetrap and think about how I create demand, that's the person who's going to make the most money, because demand driving is where it's at. So back to your question, I don't think AI is going to get there on commercial real estate. It may get you better on your rent. It may get you better at horse racing. And by the way, I'm borrowing your program for next week, but it's not going to be able to talk about the relationship between the tenant and the landlord that often has nothing to do with the economics of the deal. And so I think that AI, net, very good thing for the real estate business, the commercial real estate business in particular, because there are no two widgets in our business.
All right, I'm going to move us along because I can tell you about my opinions later. I'm on much more regularly than Spencer. Okay, so next question.
Hey, David, are you disagreeing with me? Disagree with me.
I think it's unclear. I'm not disagreeing with you. I think it's unclear. And I'm not copping out on that. Between robotics and AI, I absolutely think there's going to be a GDP increase in the capacity building phase, and we're in that now. I think the next phase will be wonderful for earnings, the companies, because you're going to see there'll be more profits because they're going to have lower costs and similar pricing. What I'm not sure about is the next phase, which is if people don't find higher value, and they might, that's what I'm not sure of. Then you're left with we're a consumption-based economy and they're underemployed. And so we could wind up in a place in 10, 20 years where it's much cheaper to produce products, but there's also deflation in the actual product itself because there's not enough low, medium level labor. But I'm not sure where I fall here. So, and I don't want to distract from you. You're the main event. Okay, so let's move on. My experience as an investor would suggest that they're speaking to the difference between the cost to own versus the cost to rent. And just to educate the viewers, in most of the markets, it's now 50 to 65% more expensive to own or to rent a lifetime. And what's really interesting is, first of all, that's enormous, huge. I mean, you're talking about $1,000, $1,500 a month difference. But what's really interesting is 5 years ago, it was parity. This is a very new thing. I mean, this all happened, and it should make sense. During COVID, rents went up and the price of homes went up. But since interest rates have gone up, rents haven't gone up, and homes really haven't corrected. It's regional in certain areas. I mean, if you were sitting in Austin, you would say, no, homes have corrected. But nationally, the numbers are the numbers. They really haven't. And so much more expensive to own than rent. So the question is this: how does it get back to a more reasonable spread? Is it homes falling in value? Is it interest rates going lower, or is it rents going up, or is it some combination? That's his question.
Well, you hate to be wishy-washy on these things, so I'm not going to be wishy-washy. Interest rates come down, it'll get us closer to equilibrium. Because right now it's the cost of the debt on your house that is doing two things. It's not only making your mortgage higher, it's also locking in existing owners of homes. What we have now is a supply dearth in the single family market, meaning we simply don't have enough supply on the market. I can't see the audience out here, but I just want to ask all this audience a question. How many of you have a home mortgage below 3%? My answer is a lot of you. And you are folks that are probably reluctant to sell your homes, even if you want to, because you're never going to get a mortgage that looks anything close to that. So it's a double-edged sword here, David. One is it's locking people into renting because they can't afford the deposit, and the cost of renting is high, of owning, is high because of the mortgage. But also there's a dearth of supply. So if you see a shock of interest rates falling precipitously, you're going to see two things happen. You're going to see more people renting or buying because people are going to have cheaper cost of buying, and then you're going to see a supply shock to the market, and the price of single family homes are likely to come down. Now, there was one assumption that was made back in 2007 which almost ended the world. You know what that assumption was, David? It was that the average price of a single family American home could never go down. Guess what? It did. And you know what? You get a significant enough interest rate shock, it'll happen again.
Yeah, and I like the fact that you step out and make, you're not, in your words, wishy-washy. So in that theme, if you will, I've changed my opinion on interest rates. I was much more concerned with our runaway federal debt, deficits, et cetera, plus tariffs, plus inflation. You know, the real rate should be 1%. In other words, the nominal rate should be 1% or 1.5% above to give you a real return. And so if inflation is, this morning it was 2.7 CPI, I think we're pretty fairly priced. You know, 4%, that's a reasonable real return historically. I think it's pretty fairly priced, but I was more concerned with interest rates going up until about 6 months ago. And what changed it for me was I think we're in the beginning of a secular move where AI and robotics creates efficiency that's, using the word you want, deflationary, or that's a scary word. But you understand my point. Like, we get caught up in the business cycle speak when there's a secular force that's probably much larger than that. And when you pick your head up, that's where I'm at. I think that we're range bound to lower, actually.
Well, look, I think we're in a lower interest rate environment. There's two things you should take or a lowering interest rate environment. That is my most likely scenario, but not at the long end of the curve, long end where you think it's going to stay around 4% indefinitely, really short end. But let me give you two counterpoints to that. Counterpoint number one is we are going to have a change in Fed chair in the spring, and that Fed chair is probably going to be dovish. And that dovish Fed chair means he's going to drop interest rates. He or she is going to drop interest rates faster than we think, which might be a good thing for construction, but it's not a good thing for the long end of the curve because the bond market might revolt. So that's thing to consider, number one. Thing to consider, number two. There was a great book written in 2018 by a terrific economist by the name of Robert Gordon. It was called The Rise and Fall of American Worker Productivity. All right, long title, even longer book, about 800 pages. But if you buy the book and you skim it and you look at the charts, it has one basic point. From 1974 till 2018, when the book was published, the average worker's productivity did not go up on a percentage basis. What does that mean? It means that the period when you had the cell phone, the personal computer, and the internet, it didn't boost productivity, like skyrocket it like it was anticipated. So the counterpoint to AI being the panacea to all of our productivity woes, I think has been disproven, at least in that book, by prior technological improvements that we thought were going to do what AI is being promised to do today.
That's really interesting. All right, we've got a lot more questions. I got to move us along. So I'll just summarize. What is your opinion on cap rates going into next year? And let's just limit it to multifamily.
Sure. So our point of view on cap rates is let's both assume that cap rates are in that mid fives range right now for an average multifamily market rate deal in the country. All right, 5.5, 5.25, 5.5 maybe. I think that next year they're going to go down marginally. When I say marginally, no more than 25 basis points next year. And I think ultimately they go down by 50 basis points from whatever we think they are today. So let's assume that they're 5.5 today, they go down to 5. If you think they're 5.25, they go to 4.75. Will the best stuff trade inside of that? Probably. But what is the best stuff? The best stuff is not just the most liquid stuff, which is in the major market. It's the stuff where you anticipate the fastest rent growth. So you go to certain markets, and I've been in these markets recently. And these are markets like Boise, Idaho, Columbus, Ohio. Where was I last week? I was in Raleigh last week. And they were all complaining that rents were going up a lot. Why? A lot of people are coming in there. So Raleigh, Boise, and Columbus are not the most liquid markets in the world. But because rents are going up faster, those are places where you're going to get an outsized return over those places that might have more liquidity, like a New York, an LA, a Dallas, or a Miami.
Yeah, in terms of cap rates, in some of the growth markets, you know, Nashville would be an example. High quality assets are 4.6, 4.7 now.
Yeah.
Class A. That's what we develop
I
or
gave you
own.
the
Operate.
average. 5.25 is an average. 5.25.
Yeah,
Yeah.
me too. I did the same thing, Spencer, earlier, but it does matter. Location matters, submarket matters, et cetera. But I tend to agree with you. I think cap rates are going to go down, but it's not just because interest rates will stabilize to perhaps even go lower. It's also because cap rates are a reflection of the weighted average cost of capital. That's what we're talking about. We're talking about interest rates. That's debt and equity on a weighted average. But it's also a function of growth expectations. And you can have a low cap rate in a higher interest rate environment if growth expectations are very, very high. And that same dialectic obviously exists in the stock market. I mean, there's incredibly high PE companies, and they're justifiable if they have huge growth rates. You hear about these things. Real estate's no different. We're an investment. We're a substitute good. I think cap rates will stabilize to go lower. What's interesting about our developments, in every development model we run, we make an assumption that cap rates are going to go up. And so that's the way myself and our analysts and our teams build in what we call conservativeness into the models. And so if I'm looking at a 5 cap and I'm thinking we're going to make 20% IRRs, I'm assuming we're exiting at 5.5. And so what we were talking about vintage earlier, if you run into a vintage where it doesn't go up, or maybe it doesn't even stay at 5, maybe it goes to 4.7, that's when you can get 35, 40 IRRs. I mean, the math changes really quickly, and everyone always presumes that it's going to be quickly to the bad. But investments are a distribution. I mean, it can go to the bad, it can stay exactly where you are, it can go your way. I've been doing this long enough that I've had all three happen. I've had upside surprises, downside surprises, and a hell of a lot that's kind of stayed in the band of what you expected. But I do agree with you. Now, that said, what are the headwinds? So we're kind of agreeing. Cap rates stabilize, maybe they go down. Interest rates stabilize, maybe they go down. What's the biggest challenge that could emerge next year? Where again, hopefully you'll come on again, and we'll talk in a year, and we'll say, okay, this is what we got right. This is what we didn't. What was the headwind that emerged that we weren't assuming?
Well, the biggest headwind is you're talking to a guy here who is a avid horse racer, and I still haven't figured it out. So headwind number one is, why do I spend so much time on this and just it's not working for me? But I still love it, and I'm going to get there. But I think the biggest headwind for us next year is really funds flows. So we had a major shock back in April of this year. And going back to your point earlier, when you're talking about value, it's fundamentals and funds flows. This is the fundamental debate. Is NOI matter more? Does funds flows matter more? Funds flows matter a lot more. When I say a lot more, I mean a lot more. Because ultimately, foreign capital will go to wherever they have the best return. In fact, I say this about cities, that your city is immobile, but capital and labor will go to where they have the best opportunity. Simple as that, right? So back to your question of 2026, what is the biggest shock potential? I think the biggest shock potential is that funds flows dry up. And when funds flows dry up, it could happen in one of two ways. One, we had a shock in April of this year where foreign investors, I got calls from many foreign investors. They said they're done with investing in the US because of the tariff situation. That changed when the tariffs turned and they looked at the math and it was better off. The other thing that could change next year is the interest rate environment. Again, I keep going back to the same point. I'm like a broken record on this thing. If we get too shocking on the downside, meaning we drop the short end of the curve too much, you're going to get a shock on the other end of the curve. The long end of the curve is going to go up a lot, and that's going to really hurt the market. So I think next year, the most likely scenario is slow and steady winning the race, interest rates coming down a little bit slowly, but slow and steady. I think that is the most likely scenario. But I think the biggest risk scenario is that we get too dovish of a Fed, they drop rates too quickly, and it impacts the long end of the curve, and it could tank the market. I don't think it's going to happen. I think the current administration has a scorecard, and part of their scorecard is stock market performance and GDP, so they don't want that to happen either. But that's the risk factor as I see it.
And one thing the Fed's doing that's not talked about enough is they've started buying again. They're increasing their balance sheet. They announced that. That's not discussed enough. That's a big deal. And in terms of issuance, because we have to issue trillions of dollars in bonds every year to refinance our debt or finance our deficits, we've moved to the far end of the curve, the short end. And so essentially what I'm saying is we're issuing 30-day paper and the Fed has started buying it again. And so this isn't by accident. This is a way to keep long-term rates down. I mean, I'm not saying it's going to work, but it makes sense.
Scott Besson is very, very focused on that. That is how he issues. He has a lot of say in how treasuries are issued, and the duration of them, to do exactly what you're suggesting.
Yeah. Okay. So different question. How do you see the changing work patterns? We're going back to more office, basically, right? We're 4 days a week at Origin. A lot of firms are 5. That just wasn't true 4 or 5 years ago. So how do you see this changing investment in multifamily in the various regions of the country?
I think we've gotten to a point where we have marginal returns on people going back to the office. When I say marginal, yeah, I still think people are going to go back a little bit more. Yes, the population is still going up, albeit slowly. So there is going to be more demand on office space. But what you're really asking, when you're asking about office, when you're asking about multifamily demand versus office, you're saying, well, am I going to spend more time in the office, or am I going to spend more time in my home? And your home is disproportionately a rental. So my answer to you is you have to look at the market. So if you go to the major markets, so this is a comment that actually comes straight out of Asia. So why do you have more people going back to the office in Asia and Europe than they do in the US? Twofold. Number one, people tend to be closer to the office physically in these markets in the US. The US is much more spread out. We have a much less dense population. The UK is 6 times more dense than the US, just to give you a statistic. But also people have smaller dwelling units. And if you have a smaller dwelling unit, you're more likely to get out of it and go to an office. So I think when you go to these major markets, they sort of have a double benefit here. They have super high rents per square foot. They also have smaller dwelling units, and they tend to be disproportionately high financial services and or high-end tech, and people are going to be in the office more. So I think when you're asking yourself the question of what demand's going to be and when people are going to go back to the office, much like we ballpark cap rates at 5.2, but Nashville's 4.7, you can't ballpark going back to the office. In the major markets, they're going to go back a lot more, and the units are smaller and you get better rents. So it's these markets that are more rural, that are smaller, where you might actually have more multifamily demand for bigger units because they don't have the same demand to go back to the office.
Spencer, I talked a little bit earlier about the cost to build versus the cost to buy. In certain instances over the last few years, mainly podium and high-rise construction has been below replacement cost, less so in garden and wrap. But where do you see that now? Is it better to build? Is it better to buy? And I know what you're going to say because you're right. It's idiosyncratic. It depends on the location, the deal, et cetera. But just from a macro standpoint, because it's a question we get a lot, if we're an investor, where are you looking to allocate towards development of new product or the purchase of existing?
Comes right back to that thing I said before, David. It's your time horizon. If you have a 3 to 5 year time horizon, it's a terrific time to build. If you were a long-term investor, there are some asset classes that are underpriced today. I think that office is underpriced today. I think that there are certain multifamily assets that are underpriced today. I just got back from Portland, Oregon, okay? And they're buying them at cap rates north of 6. Why? Because there's not as much demand there and there's concerns. And I said, listen, this is a great deal because Portland's got long-term great demand drivers, notwithstanding its current problems. So it's and by the way, they're not building anything new in Portland either. So some of their short-term problems in demand are being mitigated by no new supply. So it is idiosyncratic like that. But the places that I like are the places that have a macro issue, but a micro opportunity. So a market that gets, quite candidly, not enough love is Chicago. Chicago, Cook County, a lot of people are very scared about investing there, and I get that. It has to do with taxation, it has to do with pension fund liabilities, among other things. But we just did a big multifamily deal in the suburbs of Chicago that was oversubscribed. And I just took a look at the rent growth projections. Our rent growth projections in Chicago are second to San Francisco. And Chicago is a market that a lot of people have redlined. So you have to be very discerning when you're investing on not only the market, but the sub-market. And sometimes the markets that are most disfavored may represent the best opportunity.
Yeah, couldn't agree more. And certain states have structural advantages to others. Arizona, for example, we can talk about that another time. What is the tax benefit for investing at Origin Investments? I'll answer this one. Look, we have 5,000 investment partners. Lots of them are through their investment advisors. We have over 100 partner firms, investment advisory firms. They're homogenous. We have one type of client. They're all taxed. We don't manage money for pensions. We don't, and I have nothing against pensions or endowments, but they have different goals. They're not taxed. And so everything we do here is to generate return and then mitigate taxes. And we do that through normal, just real estate you can depreciate, which is amazing for tax reduction or elimination. We do things like QOZ, qualified opportunity zones. Obviously, there's no taxes at all if you comply. We're one of the largest investors in that space. But then we also do subsidiary REITs on everything we do. And real estate is really unique. Spencer, I think you would agree. Part of the tax bill of 2017, but it was now made permanent, which is so amazing, is that we get a 20% reduction on all dividend income, whether it's credit, our credit fund gets that, or through equity investments. And so all of our funds have that. If you were a pension or endowment, you would view that as an expense. Like, I don't want that. It's just an added expense. But if you're a person like myself or Spencer or you, getting a 20% reduction on your tax rate is pretty incredible, actually. So that's it's not an Origin thing. All real estate gets that if you have real estate as either collateral or the asset itself. Last question, because I want to be, and then by the way, Spencer, if you had anything you wanted to cover and wasn't, I'll leave it open-ended. But the last question was credit spreads. Where are they today? The question was framed as corporates, but I'm going to change it. Credit spreads on borrowing for multifamily real estate. Where are they today versus a year ago or 2 years ago or 3 years ago? Where are they heading? What is it sort of reflecting in the market?
They're as tight as they've ever been. I mean, they're getting, super tight. The AAAs, as tight as they've ever been. And it's a very good time to borrow, albeit you have a higher base rate than you did, obviously, 5 years ago, though the base rate is coming down. So the spreads have come in significantly, which is why, and I'm not sitting here just to pat you on the back, but that's why your shift from being preferred equity debt provider to being an equity provider makes sense, because the spreads came in so much, because so much capital came into the space, a lot of private capital, non-bank financial institutions, that it caused significant spread compression. So it's a very good time to borrow, albeit the base rates are higher. You're getting the benefits of that from a construction loan standpoint. But nevertheless, from my point of view, spreads next year, assuming we don't see an exogenous shock, should stay about where they are right now. There's a lot of capital out there looking for a home.
Yeah, I agree with that. Spencer, do you have anything that you wanted to cover? I tried to frame, and we had questions that were also emailed in, but is there anything that you came on and said, man, I really just wanted to talk about this today? Open mic.
The open mic moment is, look, I'm a big multifamily fan, and I'm not just saying that because I'm on this call, but I do believe strongly that when you invest in multifamily, you should look at the different segments of it, because the different segments of it give you both different types of risk and return. The Capital A affordable was not an institutional asset class until recently, and now it is, because they've dropped operating expenses. SFR, BTR, it's going to be with us for a long time, single family rental, build to rent, but market rate housing in the multifamily sector, there's no new supply there either. So there's a case to be made for each one, but I think the best case to be made is to having a piece of each.
Well, thank you so much for coming on. And before we sign off, if I'm listening in and I want to hear more, how does someone get the weekly take? When is it live? When can they download? Where do they go?
Well, thank you
I'd
for
love to hear that.
the shameless
Sure.
plug. We are very fortunate. We had our luncheon yesterday. The weekly take, it's CBRE. It's the weekly take. You can look for me, CBRE.com. Very easy to find. It's the #1 most downloaded podcast in the world. We have a variety of topics. We've had several shows on multifamily. We've had all other asset classes. And by the way, even if you're an investor in multifamily, you should look at all asset classes because you'll learn more about the pros and cons of each. And it'll just make you a better investor overall. And hopefully the weekly take can help you get there.
Terrific. Well, thank you so much for coming, Spencer. I really appreciate it. And I know our viewers do and our partners. Thank you for tuning in so close to the holidays. If your question wasn't answered, I was serious about the regional questions. There was probably 10 to 15. David at origininvestments.com. We will try to answer them. If they're California and Ohio, because I did hear that, we don't cover those areas. So if it's a credit, I can answer it. But if it's specific to equity, we don't cover those areas of the country. Happy holidays, everyone. Bye-bye.